Hello folks, today it is going to be a quick session. I will show you how to use RSI correctly. Most of the traders make the mistake of trading RSI on the basis of overbought and oversold areas. But that is not the correct way to use RSI. First of all, I will enlighten you about RSI, that what it is and how to use it. RSI is actually an acronym. The full form of RSI is Relative Strength Index. RSI is one of the most commonly used indicator in trading. So, what is the best way to use RSI? The best way to use this indicator is to use its divergences. What is the divergence? Divergence is the incongruity between the price action and the indicator. So basically today I will show you how to use RSI divergences properly. We are having two main types of divergences. The first one is regular divergence and the second one is hidden divergence. These both divergences are further divided into two divergences. So we will start from regular divergence. The first one is regular bullish divergence. What is regular bullish divergence? Here, the price action makes lower low and the indicator makes higher low. Let me draw an unacceptable illustration on the pen to have you a little understanding. It is like the market makes here the market made lower low and the RSI indicator will make a higher low. So this illustration is for price action and this one is for RSI indicator. Don't be panic, I will show it to you on the charts too. The illustrations are not important. What is important is to understand the concept of divergences. So that is how regular bullish divergence looks on the chart too. The second one is regular bearish divergence. Here price action makes higher high while the indicator makes lower high. Let me show you another unacceptable this. What does the price do? Price make a higher high. This way. Price made a higher high and the indicator makes a higher low. So again the illustration is not important. What truly important is to understand the concept of divergences. Now let me take you to the charts to show you how regular bullish divergence looks and how regular bearish divergence look on the charts. Okay, here I just explained the price action has made a higher high over here at this point. Now let's see the indicator. What has it done? The indicator has made a what does the indicator? The indicator has made a lower high. So which type of divergence it is? You can see this way. The price made higher high where the indicator makes lower high. So this is regular bearish divergence. The reason it is called bearish divergence because it turned an uptrend, a bullish trend into a bearish trend. That is the reason it is called as regular bearish divergence. So it was the example of the second type of regular divergence. Now let's come toward the first one. I have drawn this area for myself. So this way the video will not get lengthy. I have drawn it. This is where we can see the market, the price section has made a lower low. And the indicator, the RSI, has made a higher low. We can see it was the low point, and after this the market made lower low and the indicator made a higher low. So these were the example of regular divergence. Let me add you something extra to you. Whenever a divergence appear on the chart, then a trend reversal, a reversal in the trend is imminent. And at least if it don't turn completely, it will give you some move to catch. So now let's come to what hidden divergence. There are further two types of hidden divergence. The first one is hidden bullish divergence. Here the price action makes a higher low and the indicator makes a lower low. Let me show you another example. The price action will make a higher low this way. We can see price action make a higher low and the indicator RSI will make a lower low. So it is a point where we come to know that the trend reversal is happening. So now let's discuss the last one, which is hidden bearish divergence. And the price action makes a lower high while the indicator makes a higher low at hidden bearish divergence. Let me draw another illustration here. The price action make a lower high while the indicator makes a higher high. This one is for the indicator and this one is for the price action, the market. The indicator made a, we can see, higher high and the price action made a lower high. Now let me show it to you on the charts too. This is the area where the market made a lower high and the indicator made a higher high. So it is obviously for the hidden bearish divergence. We can see as I discussed, and we can see the move after the divergence. The market moved almost for 230 pips. Now let me show you another example of hidden bullish divergence. Whenever it is called as bullish, then that is the point you know the market has turned uptrend into an uptrend from a downtrend. Or let me show you another example of hidden bullish divergence. We can see here the market has made a higher low and here the indicator has made a lower low. The reason we call it hidden bullish divergence because it turned the market upside and it makes the market in a bullish trend. And the reason we call it bearish divergence because it turns the market from an uptrend to a downtrend or from a bullish trend to a bearish trend. So I hope you understand the concept of divergence. Here I will add something that the remembering the name of the divergences is not important. What is truly important is to understand the concept of divergence and to know how the market works and how it works when the divergence appear in the market. And it is imminent. Whenever a divergence appear, the market will turn, and if it don't turn completely, it will at least give you some move. So for today, I think it will be suffice. Don't forget to like and subscribe my channel for More such